All right, now for market reaction to today's jobs data and where investors are really finding value. Let's bring in Don Wordell. He's fund manager over at Ridgeworth Capital Management. He is fund manager for the Ridgeworth Mid-Cap Value Equity Fund, which is beating more than 92% of its peers over the past year, so a good long-term track record. He joins us from Orlando, Florida. Don, good to have you back on Bloomberg. Good afternoon.
Hi, thanks for having me on.
You know, Don, I hear a lot of people talking about euphoria on the trading floors today following the jobs report. Does this report give you reason from an equity standpoint to be euphoric?
We don't think so. We don't use a top-down in our investment process at all. We normally use it just to confirm fundamental momentum, and that's what you're seeing. I mean, these jobs numbers get revised so many times that trading off this number alone is really quite senseless. But it is moving in the right direction. We're not losing close to 700,000 jobs a month. Now we're only losing 250, 275. So, you know, it's moving in the right direction, but like you said a minute ago, we still are losing jobs. We're not creating jobs, and so we're still, you know, a long way from getting euphoric.
Well, that's, you know, I look at covers of magazines, they're saying, well, the recession's over, and it's like everybody's saying glory days are here again. I mean, are they in your view? I understand some of the trends that are certainly getting better, but are we getting too enthusiastic too quickly in your view?
I think so. I am not at all thinking that the recession might be over, but with its technical definition. But the consumer still has a tremendous amount of debt that they have to pay down. I mean, there's going to be a long deleveraging process that does not get fixed in 6 months or 8 months. This is going to take a long, long time. And I really think that you know, in a few years we're going to be talking about a different normal than what we are used to, and that so the market might be you know, we're just cautiously optimistic here. We're excited about the you know, the way it's going. It's not continuing to decline at such drastic pace, but you know, we're not out of the woods yet, and you know, that just is it's a positive, but we're not getting too excited.
So when do you get excited? It's Kathleen here. You know, consumer spending has been somewhat negative, but as we head into recovery, history will tell us the consumer will spend more money. The unemployment rate will fall. At what point do you say the market's justified to take another leg up in this rally and say head for 10,000 on the Dow?
Yeah, you know, for me, it's just going to be a matter of time to delever. If we're talking about consumers specifically, you have to delever. You know, we build our portfolios one stock at a time. So, you know, we try to stay away from these top-down calls on the market and the consumer. It never works out. But, you know, when we're looking at consumer stocks, which we are underweight the consumer space in our portfolio, it's really a function of we just think that there's too much leverage on the consumer. And, you know, once again, we haven't created jobs. We're still losing jobs. And so we're just not that excited about it yet. So
having said that, Don, should investors not be taking on too much risk right here?
I would just be very cautious. I would build your portfolios one stock at a time. You really have to start at the bottom up with your portfolio with the stocks you own. I wouldn't make broad calls on the market or on different sectors. I would build it one stock at a time.
All right, Don, sit tight. We're going to take a break, come back and talk some more. We are talking with Don Wordell. When we come back, we'll get some of the stocks that he likes. As I mentioned, he's been a top-performing fund manager over the last... All right, everybody, back at 12 minutes after. Talking with Don Wordell. He's fund manager for the Ridgeworth Mid-Cap Value Equity Fund, which is beating more than 92% of its peers over the past 5 years. So, Don, let's talk strategy. And in terms of picks, one of the names that you like is Republic Services Group, ticker RSG. It's had a nice run since those March lows. It's up about 57%. Waste management company. What is it that stands out in your view about this one?
Well, we really like Republic Services Group because our process, the tenets of our philosophy revolve around three things: dividends, valuation, and fundamentals. So the stock pays a very nice dividend yield of around 4% or between 3 and 4%. The valuation is very compelling at 6 times EBITDA, and there's quite a strong fundamental story with the Republic Services Group based on the delevering process that they're going through with the Allied Waste merger. They took on a lot of debt, and they're aggressively paying down debt with their free cash flow, and all that equity then accretes to the equity holder, and and they've been able to maintain pricing through this recession. So we're you know, we're really excited about Republic Services Group. We've got a target in the low 30s.
All right, but as you know, at the end of July, the company reported that profit fell 22% because of a drop in value of recycled material and the energy that the company generates from garbage. I mean, won't the company, though, Don, remain under pressure until the economy takes off substantially? I mean, these are still going to be problems for the company.
Absolutely. They absolutely could be problems for the company. Volumes were down worse than the street expected, and that's fine. The important key for me is pricing, because the waste business and waste management has become such an oligopoly that Republic Services can still get 3 to 4% pricing growth, and when volumes come back, it's going to be very accretive to earnings. And even in this environment, they're going to generate $700 million in free cash flow this year that will accelerate the debt pay down. So, you know, I'm very aware, and so is the market, of the you know, the economic issues, but this company's managing through it very well.
I'm assuming that also applies to a name like Valero, up about 19% since mid-July. You're aware, obviously, of the issues surrounding this as an energy player in terms of the economic constraints, but nonetheless you like it.
Valero is a very controversial stock. You know, great dividend yield. The valuation is very compelling on an EBITDA basis, or just if you look at the fact that you couldn't replace or recreate these assets for less than 2 to 3 times the current equity value. Valero is just, it's being punished because of a collapse in refining margins. And, you know, if we are getting some kind of economic recovery here, then refining margins should firm up.
Right.
And when that happens, you'll get more. The other thing that's impacting Valero is the spread between the sour spread, they call it. And so Valero is a complex refiner, and we think that you're going to get more. You know, you're going to get more capacity come online of the sour crude, and that will help the refining margins both ways.
All right, good to know, and good to get some time with you. Don, thank you so much. Don Wordell, everybody, joining us this afternoon.